to the first session of a 4-money lecture series by the Institute of International Monetary Research in collaboration with the Vinson Centre at the University of Buckingham. This is a series on the evolution of central banks and their roles in financial crisis by 2 very well-known experts in the field, Professors Charles Goodhart and Professor Capie, both members of the Institute's Academic Advisory Council. I'm Dr. Juan Castañeda, Director of the Institute, and today we'll be hosting Professor Charles Goodhart. Charles Goodhart needs no introduction. He was trained as an economist at Cambridge and Harvard. Then he entered into a career that alternated between academia at Cambridge University and LSE, and worked in the official sector as well, mostly in the Bank of England, in different departments in the 60s, 70s and 80s. He also joined the Monetary Policy Committee of the Bank of England from 1997 to 2000. He has worked throughout as a specialist monetary economist, focusing on policy issues and on financial regulation, both as an academic and in the Bank of England. He devised the so-called the corset in 1974, advised Hong Kong on the link in 1983, and the Reserve Bank of New Zealand on inflation targeting in 1988. As he puts it, he has written more books and articles on these subjects throughout the last 50 or 60 years than any sane person would want to read. Well, I haven't read them all, but I vividly recommend you to read at least one that would be very relevant to this series, his excellent 1988 book, The Evolution of Central Banks. Professor Goodhart will discuss today central banking, past, present, and future, after which we'll allow time for Q&A with viewers at home. Today's presentation will be recorded and made available on our YouTube channel. You can go and visit our website, mv-pt.org, to access this and other webinars in our series.
Let me start now. I'm going to start about 150 years ago, at the beginning of the 1870s. One's got to start somewhere, and 150 years is long enough. The beginning of the 1870s marked the beginning of a period when central banks were confined really to Western Europe, and all the central banks in Western Europe agreed on the general policies that a central bank should follow. These included maintenance of the gold standard, following the real bills doctrine. You probably don't know what the real bills doctrine actually was. I'm about to tell you later on, and it formed a very important part of central banking in the way it was undertaken at that time. Following the crises that had occurred in the middle of the 19th century, like the Overend Gurney crisis, and the book that Bagehot wrote on Lombard Street, the central banks had begun to understand that they should act as lender of last resort in financial crises and to support banks when there were runs on them which were unjustified. Now, during the 150 years in which we are covering from 1870 up to 2020, there were periods when central banks generally knew what should be done, and there was a consensus on how policy should be managed. There were, however, and there have been, intervening periods when there was a great deal of uncertainty about what central banks could and should do. The first period of uncertainty was brought about by World War I, which led to a breakdown of the gold standard. The competent countries in Europe all used their gold resources, their reserves, in order to buy munitions from the United States, which for 3 years was not involved in World War I. So the gold all migrated out of Europe into the US. Virtually all the countries involved in the war left the gold standard, And after World War I, there was a question of whether you should go back to the gold standard, which the UK did in, as I recall, 1928, or where you were so far away from the gold standard that there was no possibility of going back to it, as was the case with France. There was a breakdown of the real bills doctrine, and again I shall explain that shortly. And as everybody knows, from 1929, the Great Depression occurred. There was massive unemployment, and there was actually deflation. I'm afraid the diagram says inflation. It was unemployment and deflation. As a result of the unemployment and deflation, a variety of measures got taken, and in particular, from 1934 onwards, the fiscal authorities began to dominate. There was fiscal dominance. The Keynesian doctrines of using fiscal policy to try and restore and maintain full employment began to be increasingly prominent, particularly during World War II and afterwards. The central bank became subject to the finance ministry. Montague Norman, the great governor of the Bank of England from 1919 for about 30 years until the end of World War II, expressed his willingness to allow the changes in interest rates to be determined by the Minister of Finance. There was financial repression, cartels were encouraged, competition was discouraged. Again, I shall explain a little bit more about why that happened. And the interest rates were used to maintain balance of payments, to try and encourage people to invest in the UK and to dissuade them from investing abroad. And when interest rates were not used for balance of payments purposes, they were otherwise kept as low as possible in order to encourage corporate investment. And because during World War II, the government ran huge deficits, the debt ratio surged upwards, much higher than it is now. It ran well over 250% of GDP, and with such a high debt ratio, ministers of finance were very keen to maintain low interest rates. So from 1934 to 1970, the central bank knew what it was supposed to do, but what it was supposed to do was actually be very subservient to the Ministry of Finance. It was a sub-branch of Whitehall, and that was true in most countries. Then, towards the end of the 1970s, there was a move towards liberalization, and the competition was allowed to recover. The exchange controls over capital flows were reduced, and there was a move towards attempt at greater growth and more expansion. In particular, the exchange rate system that we had after World War II, the Bretton Woods system, was one where exchange rates were pegged initially to gold, but then to the US dollar. And you were allowed to adjust your exchange rate. So it was a fixed, but it was an adjustable peg system. But you were only supposed to adjust your exchange rates, which was regarded as a symbol, as a sign of bad governance, if things got fairly desperate. Now, the Bretton Woods system fell apart for reasons that I don't have time to go into at the beginning of the 1970s. And that allowed many of the countries, particularly including the UK, to try and have a dash for growth. Prior to the breakdown of the Bretton Woods system, there was what was known as the stop-go system, which was you had a a foreign exchange problem. The UK had too many debts built up in World War II. And we were never sufficiently competitive at that time. When we had a foreign exchange problem, then we would raise interest rates and we would go into a period of slight recession. Then, with help from our allies abroad who would lend us money from time to time, we would recover from the, the balance of payments weakness, and we would try to grow again. But every time we tried to grow and expanded the economy, there was a tendency for the foreign exchange position to weaken again. And so we had yet another stop. When the Bretton Woods system broke down, what then occurred was there was an attempt to have a dash for growth in order to get investment up sufficiently to raise productivity, sufficiently to keep inflation in check. And it didn't work for a variety of reasons. At that time, also, there was a great dispute between the theories of monetarism, that what you needed for controlling the economy was stable monetary growth, versus Keynesianism, which was trying to maintain stability through adjusting basically fiscal policy to leave the level of unemployment at a point which was as high as possible without leading to too much inflation. And the monetarists, in my view, correctly claim that the level of unemployment which the Keynesians were continuously trying to achieve was higher than was consistent with stable prices. Keynesians said that if you tried to tighten up, you would simply have recession, and tried to reinforce the degree of unemployment that they were prepared to concede with direct controls over wages and prices. For a whole variety of reasons, those direct controls didn't work. What you also got was liberalization at the time, partly a result of the improvement of communication, the reduction of exchange controls. And as the financial system became liberalized, so very frequently the banks involved went for maximum growth, and that led to monetary expansion, that led to inflation, and that led to financial crises. The 1970s were actually the most horrible decade of the post-war period, at least as bad, if not worse, than the period after the great financial crisis. Eventually, through being tough and preparing to cut back on monetary growth and raise interest rates, both Paul Volcker and under Maggie Thatcher and others, the UK and the US managed to bring down inflation and restore some degree of stability in the 1980s. But we didn't have any very clear idea of how we were going to run the system. We didn't know what the anchor was going to be. We didn't want to return to the gold standard because it had been, an attempt to do so had been disastrous in the 1930s. We tried from time to time to think of pegging onto the Deutschmark, or joining the exchange rate mechanism, but there were problems, as you know, as a result of what happened in all of that. And so then what happened in the 1990s was that there was another period when there was a degree of consensus, where the way to deal with the problem of excessive inflation, political pressures to lower unemployment to below the natural rate, was to have an independent central bank with an inflation target set by the political authorities. And for the next 16, 17 or so years, that worked absolutely brilliantly. We had what was known as the Great Moderation, or the nice years, and again I'll explain the nice years in a moment or two. which were probably the best 15 or 16 years, economically speaking, in the history of the world. Inflation was low. We kept pretty much, by and large, to the inflation targets. Unemployment remained quite low. Growth remained really pretty steady. And in particular, although inequality within countries began to rise, the greatest form of inequality up to that date had been between countries, since the developed areas like the Western Europe and America had grown relatively fast, but much of the rest of the world and the most populous part of the world, which was Asia, had not grown. So that the standard of living in China and India in, say, 1980 was not all that vastly different from what it had been in 1815 or 1800, whereas the developed world had grown 10, 20, I can't remember, but massively. What happened in this period was that Asia began to grow very, very much faster, particularly China. And that meant that the difference is between wages and incomes between countries began to decline really very sharply. Then in 2008, we had the great financial crisis. That led to financial stability. That brought about a degree of disinflation, relatively slow growth, and despite having relatively low unemployment. So after the great financial crisis, we managed to restore the level of employment, but we never got growth going again because productivity has massively disappointed in the 12 or so years since the great financial crisis. And now, of course, we've got coronavirus and all the effects of that. Okay, can we now have the next slide, please? Okay, let me go through the real bills doctrine, which, as I said, was perhaps the main theoretical basis for central banking activity in the years between about 1970 and the 1920s. What real bills meant was it was bills that were drawn on and based upon goods in process, goods in being exported and imported, tradable goods, goods that were being produced by a company. When you import and when you produce goods, it takes time between you buy the goods and time between you pay the wages when you sell the goods, which then get the money in order to repay the bills. Now, there were 2 points about the real bills doctrine. First one was that if it was a real bill, i.e. it was based on real tradable production and goods, then there was an automatic degree in which it would be repaid. The second element in the real bills doctrine was that if the volume of real bills was increasing, it meant that the volume of transactions, real transactions and turnover in the economy was increasing as well. So I assume that you're all by now, at least in Buckingham, fully aware of the relationship, in fact the identity, where MV equals PT. If you relate the rate of change of the monetary base to what is happening to overall activity and turnover, i.e. to T, and you assume that velocity is relatively constant, then you can increase M in line with T without bringing about any change in P, in other words, in the price level. So the real bills doctrine was a way of trying to maintain price stability. Note that the word real in this case is not the same as sort of real interest rates, what we now talk about. In modern economic parlance, real tends to mean after adjustment for inflation. In the 19th century, real meant as distinct from financial, which was bills that were taken out in order to finance speculation, to finance asset purchases and so on. And the argument there is that if the purpose of taking out bills was speculative and for buying assets, then it would lead to inflation, whereas if you related it to real bills, it would not. Now, note that at that time, open market operations and the change in the monetary base were undertaken through purchases and sales of bills of exchange from the private sector. It was not undertaken, as it now is, by purchases and sales of government, usually short-term debt. Back in the 19th century, the main reason why governments ran deficits was when they went to war. And wartime involves blowing things up, and that leads to no increase in production. And particularly a losing government, a government that has lost a war, usually is not in a position to repay its debt very easily, and it will try to inflate things away. So government debt was regarded with suspicion in the 19th century. Financing a government was regarded as much more inflationary than financing of trade, in other words, of real bills. Now, the problem with the real bills doctrine is that it is pro-cyclical. And the reason here is that when the economy expands, when there's a lot of enthusiasm, when there's a lot of activity, real bills goes up. When the economy contracts, as if there's a crisis and something goes terribly wrong, then the volume of real bills goes down, and it means that the money supply will go down and base money will go down in line with the decline in the volume of bills. And that's very much what happened in the United States in the 1920s, the end of the 1920s after the 1929 crash. In the early 1930s, the US economy was so short of activity that there weren't enough real bills for the Fed to buy or to repo in order to expand the monetary base. The next point that I want to make is that the way that the crisis was interpreted in 1929 and between 1929 and 1933. One of the reasons why people thought that the crisis had occurred was they argued that there had been too much competition driving down profit margins and making the banking sector reach for yield and undertake more and more risky activities. An argument which is very rarely heard nowadays. And one of the answers that was applied to stop that was to encourage or induce all the financial intermediaries to join into cartels where the interest rate would be set, usually in relation to the central bank rate, and competition was consciously reduced. It's an interesting idea which has now completely fallen out of fashion, that within the financial sector, excessive competition leads to excessive risk. And it's something that actually should not be entirely ignored or disregarded. As I've said, the years between the adoption of inflation targetry and central bank independence were what were described by Governor Mervyn King as the nice years. And that stood for non-inflationary, continuously expansionary. Why did that occur? Well, it occurred in some large part because of the improved regime of monetary policy that the central banks were actually bringing into effect, as contrasted with the tendency for excessive monetary expansion in the 1960s and 1970s, and the repressed period prior to that. Now, why did the nice years, did it end? Why did we have the great financial crisis in 2008, 2009? So can we have the next slide, please? Well, I'd like actually first to go through some key trends over the prior years. This is to describe a bit some of the trends over the good years, the Great Moderation. One of the reasons why it wasn't so difficult for central banks to keep price stability, to maintain an inflation target. And having been on the Monetary Policy Committee myself at the outset, I can say that we didn't really have to do all that much. We changed interest rates by 0.25% every now and again, but it wasn't actually an enormous problem. And one of the reasons why that was so was that there was continuously disinflationary pressures arising from demography and globalization. The reason the disinflationary pressures were arising from demography was that it was a very favorable period whereby the ratio of workers in the population rose sharply relative to the ratio of dependents. Dependents are those people who depend on those who are working for support and for incomes and what they consume. And the dependents are the young, normally treated as between when you were born and about 20, and the old from 65 onwards. And the working population is those between about 20 or slightly under and 65. Now, the workers are by an increase in the workforce, if they are actually employed, is almost by definition disinflationary, because you only hire workers if they're going to produce more than the wages you have to pay them to do that production. So a greater growth in the workforce is a disinflationary force, whereas the dependents, again by definition, are consuming, are using income, but they're not supplying anything because they're not in the workforce. And therefore, by definition, they are actually inflationary. So an improvement in the dependency ratio, more workers relative to dependents, is disinflationary. In addition, there was globalization. This was years when China joined the world trading system, as did Eastern Europe after the breakdown of the Iron Curtain and the dissolution of the USSR. And that brought a huge increase in the working population. The working population between about 1980 and 2010 more than doubled. It was the greatest increase in supply side of labor availability that the world has ever seen. And inevitably it led to a huge shift in the production of tradable goods, where you could produce them anywhere in the world, from the high wage economies in Western Europe and America to the low wage economies in countries like China, South Korea initially, Vietnam now, Bangladesh and so on. And that led to a massive disinflationary tendency. Fiscal policy during this period was limited by convention and then by rising debt ratios after the great financial crisis. So what we had was generally expansionary monetary policy and a massive trend decline in interest rates, both nominal and real. And that led to great success with price stability during the nice years. But financial stability was a problem. And there was always a problem that the banks could always claim that if you regulated us more, we would be less able to finance growth. And the debt ratios were rising really quite fast, in part as interest rates were declining. So can we go next slide, please? And there were a number of generally accepted myths in advance of 2007, in advance of the great financial crisis. More or less everybody thought that as long as you achieve price stability, which we did, plus the introduction of the Basel capital adequacy requirements, that all that would actually guarantee that banks would always remain solvent. If banks were always going to remain solvent, then liquidity will always be available via the wholesale markets. Banks were thought not to have to hold liquid assets, because as long as they were thought to be surely solvent, they could always borrow at the going rate. So maturity mismatch in the banking system could be ignored, with, of course, bank lending at a much longer duration than deposits, many, perhaps most of which, were either on site callable or a very short duration. Now, that wasn't in fact true, that price stability plus the Basel capital adequacy requirements would guarantee solvency. And as for, I'll explain why in a moment, and as for liquidity, when I was young, and I'm afraid that was over 50 years ago, the banks in the UK were required to hold a liquid assets ratio of 30%, of which a significant proportion had to be public sector debt. By the time we got to about 2006, 2007, the amount of liquid assets, short-term liquid assets in the banking sector was well below 5%. In many cases, they held only about 1 or 2% in short-term public sector debt. So can we go on, please? Next slide. What happened then was that the banks, particularly in America but elsewhere, had invested very heavily in property, residential property and commercial property. And the availability of mortgages on easier and easier terms, frequently almost fraudulently low, raised housing prices enormously in the period 2004-2006. And an enormous proportion of bank loans are collateralized on property, residential and commercial. Housing prices started going south, particularly in America in 2006. And as a result, many of the mortgages where the down payment had been reduced and reduced and reduced went bust, went belly up. That led to foreclosures. The foreclosures led to further forced sales. The forced sales led to a further downturn. The downturn led to banks being no longer seen as fully solvent. When they were no longer seen as fully solvent, their liquidity came under question. They didn't have enough liquid assets. They had to sell. They were forced into selling assets themselves, forced sales of assets, which led to a further decline in asset markets, which led other banks to come under pressure, and there was contagion. And that led to the great financial crisis, particularly after the failure of the Fed to be prepared to support Lehman Brothers and the collapse of that firm. As a result, we ran into difficulties. Prior to the great financial crisis, in the Great Moderation, the focus of central banking was very narrow. It was price stability only, via the achievement of inflation targets. The instrument was simple. you varied the interest rate, the short-term interest rate, bank rate, to achieve that. Confidence in the central bank's ability to maintain price stability, inflation targets was high, and the independence of central banks was undoubted. Now, following the great financial crisis, the focus, the objectives of central banks has widened. It's not only price stability, it's also financial stability. And increasingly, with the massive increase in debt ratios on the fiscal side, the central banks are being asked to take responsibility for growth and employment as well. The instruments of central banking have increased from one to many. That's in part because the interest rate has pretty much hit what is now known as the lower bound. The lower bound being given by the fact that there is always an alternative. You can always hold cash instead of deposits, and cash has a zero interest rate. So if you try and drive the interest rate negative, much below zero, people will increasingly hold cash instead. And indeed, the banks do not pass on negative interest rates in those countries where they've occurred to their retail depositors. They've been able to pass them on in part to corporate depositors, but not to retail depositors. So with interest rates constrained by the zero lower bound or slightly negative lower bound, what we've had is a movement towards unconventional monetary policy, notably quantitative easing, with interest rates stuck. What do you do about financial stability, where we now have macroprudential measures, changes to the terms of mortgages, we have banks undertaking stress tests, we have different forms of bank resolution, bail-in as compared to bail-out. Confidence in what central banks can do has been damaged. In particular, the disinflation that has occurred between 2008 and continuing after the great financial crisis was over has meant that central banks are now less confident in their ability to achieve financial targets, and their independence is beginning to be at some risk, notably with the massive increase in fiscal deficits that have occurred. As fiscal deficits in most developed economies are now rising sharply over 100% of GDP. We passed that particular metric about a month ago. The politicians will be less and less inclined to allow central banks to raise interest rates, should that be needed to restrain inflation. And in any case, the amount of debt outstanding of the corporate sector is now so high that an increase in nominal interest rates, except being very gentle and very gradual, would probably bring about a further recession, even when the coronavirus pandemic is overturned.
Thank you very much, Charles. It was a very comprehensive presentation, and I appreciate that it wasn't easy to summarize the history of the last 150 years. So thank you so much. So let me go through the questions already sent by some of the viewers from home.
Oh, yes. All central banks are actually considering the provision of central bank digital currency themselves. Whether and when they move to that, I think, remains very uncertain. But everything is getting digitalized nowadays, not entirely to enthusiastically received by ancient elderly people such as myself. We find it very hard to get around the shift to a more digital economy, but alas, we will have to. I think the short answer to that is, unfortunately, you can't. As the work of Helene Ray has actually indicated, even if you have floating exchange rates, you are not immune and you cannot entirely protect yourself from financial disturbances that may arise elsewhere, notably in the United States, which remains the central country. One of the major changes in thinking that has occurred in the last 10 or so years after the great financial crisis, but not entirely caused by the GFC, has been a understanding that all countries, perhaps particularly emerging countries, should be very careful about allowing unfettered capital flows, both inflows and indeed outflows as well. So that you need, and there are times when you get huge surges of flows of funds out of developed economies and out of the US into emerging economies, and sometimes this reverses very, very sharply. You need to control that as best you can through carefully adopted exchange controls of a variety of sorts. Now, one of the problems is that controls of this kind can also lead to distortion, and they can lead to corruption. And as always, one of the key elements of any attempt to grow in emerging economies is that trying to get good, clean, efficient, uncorrupt governance is absolutely crucial. And the governance structure, I've often thought that the growth theories of modern economics are largely a waste of time. Growth is a function of really two and only two major factors. And these are good governance, and the second one is good education, which I'm sure that you're getting at Buckingham, so at least one part of that duo will be achieved, at least for yourselves. No, particularly now that the mechanism for managing interest rates has changed. This is a rather technical detail, but the mechanism for managing short-term interest rates has changed from a corridor system where deposits at the central bank are not remunerated with a zero interest rate to a floor system where deposits at the central bank are remunerated. So the rate of interest on base money, which is primarily deposits held by commercial banks, is now very closely in line with other short-term interest rates and has also certain additional advantages in absolute complete liquidity. And this means that unlike the old corridor system, when interest rates were generally far higher than the zero rate that was offered by the central bank on deposits with them, the elasticity of bank holdings of base money has become huge. To give one quantitative example, the amount of base money held by US commercial banks now, or actually a year or two ago when it was at its peak, was over 100 times that held before the change in the system, sort of back around sort of 2015, 2016. The stability of the money multiplier has gone. It's disappeared. It is dead. You cannot use monetary base control. It is gone. It is finished. And the whole concept of trying to assess the determination of the broad money stock through looking at the money multiplier is now it's now a totally discarded approach. At the moment, broad money, but the problem is that this is not necessarily a constant over time. It depends on behavior, it depends on structural changes to the way that the banking system works and that the financial neobanks works. It's not possible to say that any particular monetary aggregate is at all times and for all future times going to be the most important. One does need to look for a variety of purposes to a variety of monetary data. The split of assets within the banking sector is important. The division between the banking sector and, for example, in America, money market mutual funds, they're less important in the UK, but in the US it is perfectly possible that a combination of broad money and money market mutual fund liabilities would actually be a better guide than broad money by itself. So this doesn't have a clear, constant answer. The answer to the first is yes, they were wildly undercapitalized given their risk and given their importance in the social structure and the disaster that would occur if they failed and the pressures that were inevitably put on central banks and governments to rescue the financial system when such failure appeared imminent. Yes, they were wildly undercapitalized. I would go on to add that I think that the private sector as a whole, the corporate sector as a whole, is undercapitalized. The ratio of debt to equity has been going up, partly because of the incentive structure on management to maximize the return to equity. And the easiest, simplest way of doing that is to expand debt rather whenever you want to get more money rather than equity, and even to buy back equity and to do so by raising debt. So it's not just the bankers, it's all the whole of the corporate sector. And there are massive great incentives in the present structure of capitalism to lead management consciously to cut back on equity financing and to prefer debt financing. And I think that this is a major problem with the modern capitalist society. So my view is that the problem goes much deeper than just banks, and the problem relates to the structure of capitalism and the incentives that the present mechanisms for remunerating management actually to which it leads. Given that the authorities were not prepared to change the structure of capitalism radically, then I think that they had no alternative but to raise required equity ratios. And I would say, moreover, that these higher capital ratios have in a sense proved their point, because the banks have, at any rate so far, have been pretty resilient during the COVID crisis. And there have been a lot of problems, inevitably, with the lockdown and the pandemic. But banking fragility is not at the top of the list. It may get worse because when the support mechanisms get attenuated, which seems likely, because they can't go on forever, quite a lot of companies will go bankrupt. And when those companies go bankrupt, except when the government steps in and takes over again more widely, the banks will bear a lot of that burden. So the non-performing loans may well rise quite sharply in a number of countries throughout Europe, and that could lead to problems with the banking sector in the future, which are not apparent at the moment. But so far, the higher capital has been an enormous boon and benefit during the problems that the pandemic has caused. I think that it has been about as good as the legal systems would allow, in the sense that the measures that have been taken to support the economy, like QE and the low interest rate, have actually led to a massive increase in liquidity, which has supported financial stability. While the other measures that I talked about earlier, such as macroprudential measures and stress tests, have been directed to financial stability. So we've now got, sort of under the Tinbergen type approach, we've now got measures that are specifically aimed at financial stability as compared with the measures that are aimed primarily at price stability. The problem is not that the coordination has been missing. The problem in many countries is that the range of policies that the central bank can use, particularly to maintain financial stability, macro-pru measures are limited. For example, in Sweden, the FSA controls the macro-prudential measures, not the Riksbank. In America, the amount of macro-pru measures that the Fed can actually bring to operation are really very strictly limited. The central bank's capacity to use macro-prudential measures for price stability purposes is limited by their legal mandate. Yes, he's right and he's wrong. Let's start with the reason he's wrong. I have done, with Jonathan Ashworth, several papers on cash holding. And cash holding has actually been increasing. And it's been increasing after the COVID virus started. The ratio of cash holdings to GDP have gone up quite sharply. And indeed, with the exception of one or two countries, of which Sweden is an outlier, the ratio of cash holdings to GDP have continued to rise over time. So if he's talking about cash isn't held, that's not true. That's just plain wrong, and we have data to show it. Where he is right is that the COVID pandemic has led to a decline in the use of cash for payments purposes, in part because there are many retail outlets, I've been to several, which actually try and avoid being paid in cash. They want to be paid by plastic, by debit card, or credit card. And you will frequently see stores with signs saying cash not accepted. I've never quite known how that would stand up legally, since cash is legal tender. But be that as it may, the ratio of payments, if you take the payments data, the ratio of payments using cash to payments using other means of exchange has gone way down. That's true. So cash is less commonly used in payments, but more of it is held. Again, we are very uncertain about what the future will bring. Many people are very uncertain about what will happen to their incomes after the income support furlough schemes have ended. Corporates are extremely uncertain about what is going to happen to their cash flow. And as a result, we are holding much more cash than we used to. Well, not a huge amount, more cash. The increase in cash holdings has not been as marked as the increase in bank deposits, but it is still there. So cash is more held, but it is used less in payments. And I can document that. There are data to that effect. That is a very, very good question. And all I can do is actually refer him to, or her, to Paul Tucker's book, which goes over that issue at great length. I do think it's an issue, and I understand the point. Having been a central banker for much of my life, I tend to think that we could hold multiple objectives, financial stability as well as price stability, and do it well to the benefit of society as a whole. But I understand the argument that we're not elected. We are just unelected technicians, and unelected technicians should be very strictly confined for limited purposes with a limited mandate. I think it's an important issue. I understand both sides of that particular argument, and partly because of my own history, background, and prejudices, I think that a central bank, with the kind of people I know and central bankers, can be relied upon to do the best for society. But I do entirely appreciate and accept the arguments against, and those who are worried about that issue, and it's an important issue, should read Paul Tucker's book, which goes into it at enormous length. The answer to that one is yes, but it's a delicate question. Incidentally, this happens to be the subject of the forthcoming Geneva conference, which is going to be held on October the 2nd and 5th, where there is a paper on the coordination of monetary and fiscal policy. The question is not so much whether they should be coordinated, to which the answer is yes. The question is rather who should be the dominant force. And what we had with central bank independence and the monetary target was the central bank taking the lead independently and fiscal policy needing to coordinate with that. What we are, I think, going to have as a result of the massive increase in debt is that we're going to have fiscal policy taking much more of the lead and monetary policy being much more subjected to fiscal controls and political controls over the next 20 years than we have had over the last 30 years. I dislike most discontinuation of statistics, particularly when they're ideologically driven. And after all, it's a perfectly valid financial statistic. It's a statistic that needs to be reported and noted. I wouldn't want any statistic to be discontinued unless the costs of compilation outweigh the benefits, and I don't think you can make that case with an M3 statistic. But you have got alternatives which are just about as good. After all, my friend Larry Goodman and the Center for Financial CFS in New York actually provides statistics on more or less a similar aggregate. It's going to be what central banks are going to be allowed to do. I think that the difficulties of raising interest rates at this moment are so great and the pressures that will be put on them by politicians not to do that are so great that they won't be allowed to raise interest rates other than quite extraordinarily gradually. What will happen is that if inflation rises, central banks will respond initially by allowing a large proportion of their bloated balance sheets to run off. In other words, QE will be reversed, and that will lead to a relatively sharp rise in the slope of the yield curve. So the long rates will rise relative to short rates, and the yield curve will steepen. The moment is extremely flat and will steepen quite sharply over time. If after that steepening inflation is still much too high, will central banks be allowed to raise interest rates to try and maintain price stability? I think we'll have to see what the context in those circumstances looks like. It's difficult to predict what that context might be.
Thank you, Charles. We have taken enough of your time. You've been really generous with us. And of course, we have another session next week. Perhaps next week we can discuss the current debate about the review of the central bank's strategy, not just the announced strategy by the Federal Reserve, but other major central banks are reviewing theirs, as you know very well. So we look forward to your next, your second lecture, and we are very, very thankful for your presentation today and the time you have taken to answer the questions as well.
It's been a pleasure. Thank you.
Thank you very much, and thank you all very much. We'll see you next week, this time next week, with Charles Goodhart's second lecture on this topic. Thank you all.